Welcome to our Hurst Cycles webinar for the 9th of April 2018. My name is David Hickson, and I must ask you, before we take a look at the markets, to please make sure that you have read and understood these disclaimers. In today's webinar, we're going to be turning our attention back to the stock markets, or in particular the S&P 500, which is the market that we have been analyzing over the past many months. We moved away from a look at the stock markets last month when we took a look at gold, but today we're turning our attention back to the S&P 500, and we're going to take a look at what we are expecting to happen in that market because of the Hurst Cycles analysis. In my previous webinar last month, I started off the webinar, I spent the first half of the webinar taking a look at a comparison of the analysis of gold that had been performed, I think it was 18 months previously, and I looked at how the analysis from 18 months ago would have informed our expectation of what would have happened to the gold price, and how really very accurate that expectation would have been in terms of what happened to the gold price over that time. And I had a very positive response to that. Many of you found that very useful, and so I thought I would spend some time at the beginning of today's webinar doing exactly the same thing with our analysis of the S&P 500. So the chart that you're looking at now is actually the chart from February. This is the workspace from February, and I haven't updated the data, and so the analysis is still the same analysis that we were looking at then. And as you might remember, we were looking at two possibilities. The one possibility was that the 20-week cycle trough was forming in the market. Let me just highlight this nest of lows over there. That's the nest of lows for the 20-week cycle trough. And so we considered the possibility that the 20-week cycle trough was pretty much due at the time that we did that webinar, which was, of course, in the middle of February, on the 12th of February, to be exact. And so that was one of the analyses that we took a look at. The other analysis that we took a look at was the possibility that the 20-week cycle trough had occurred at the end of December. There it is over there. At that time, as you can see, I had to pin that 20-week cycle trough there. In other words, I influenced Sentient Trader by telling it I want to put the 20-week cycle trough there. Sentient Trader was obliging and did actually place that trough there so that we are able to compare those analyses. So I'm not going to repeat all of that because we discussed it in February. But the most likely analysis at the time was that the 20-week cycle trough was forming because of this very strong move down, which looked more like the move down into a 20-week cycle trough than a move down into a 40-day cycle trough. You can see here, according to this analysis, there's the nest of lows for the 40-day cycle trough. So this really strong move down could have been a move down into a 40-day cycle trough, but with such a strong move down, you expect the magnitude of the cycle to be a little larger, and so the more likely analysis is certainly the 20-week cycle analysis. The 20-week cycle trough forming at that time in February. So let's just quickly display the tools that we use to understand the analysis, because of course our Hurst Cycles analysis has been performed and we've got all these diamonds and triangles on our chart, and for somebody experienced in looking at the markets from a Hurst Cycles perspective, they understand the implications of this analysis. For somebody who's fairly new to the concept, it just looks like a really sort of pretty graphic perhaps, but it doesn't have a lot of meaning. So there are two tools that I have developed to help me and other Hurstonians visualize the implications of the analysis. And the first is the composite model line, CML for short, and I've spoken about this in many webinars before, so I'm not going to go through that whole rigmarole and explain what it is, but it takes the analysis information about all of the cycles and it projects it into the future to show us what we can expect. So here is the composite model line for this analysis, with the 20-week cycle trough expected in about mid-February. And the other tool, I'm going to come back and speak about the composite model line in a moment, but let's quickly look at the other tool, because the other tool gives us a slightly longer term perspective. There we go. This is the zigzag tool, which I spoke about in some detail a couple of months ago. And the zigzag tool works on the premise that the market tends to move from troughs in the trough analysis, down here at the bottom, up to peaks in the peak analysis of the same cycle. And that is why we get the patterns that we get in the markets, because of these sort of zigzags, what I now call Hurst cycle validated zigzags, which is a very long term, but it's basically these lines. So let's quickly speak about these zigzags, because they give us a slightly longer term perspective, and let me hide the shorter one for now. First of all, we've got this 18-month zigzag over here, just this dashed line, which I'm just going to mention, which is the first move down of the 18-month zigzag. And that is telling us that the 18-month cycle is moving from the peak, which formed at the end of January of this year, and it's moving down to the next 18-month cycle trough, which is expected towards the end of this year. So that's the longer term picture. Then, of course, we have this 40-week cycle zigzag. And you can see here the actual sort of zig and then the zag. So price moves down in a strong move, then it's going to move up to this peak of the 20-week cycle, and finally completes the zigzag by moving down to this trough of the 40-week cycle. So that's that zigzag. But in terms of what we were expecting in February to occur over the next 2 months to bring us to April, where we are now, let's take a look at the 40-day zigzag, which was telling us to expect, and let me just zoom in to about that sort of a scale there. Here we go. So the 40-day zigzag was telling us that price was going to move up from the 40-day cycle trough, which was of course synchronous with the 20-week cycle trough that was expected to form here at the beginning of February, and it was going to move up to this 40-day cycle peak. So the way the zigzag works is it initially simply draws a dashed line from the expected trough up to the expected peak of that cycle. Eventually, of course, we expect a little bit more of a detailed move, and we expect the zigzag to form. But back in February, all that we had was this information, which was that price was expected to the 40-day cycle was expected to influence price to move up to a peak, and the exact time and level of that peak is shown on this chart. It was expected within this circle, as you can see, so sort of roughly around about 2730 up to 2750, that kind of thing, maybe all the way down to just above 2700. But the exact date that that peak was expected is calculated by the zigzag tool. It's actually, as a matter of interest, the center of gravity of this nest of highs, because of course here we have the nest of highs. So it's the center of gravity for that, or the calculation that's used is the calculation that you use to calculate the center of gravity of something. And so it calculates the expected time for the 40-day cycle peak to form as being the 12th of March of this year. So if you've got a pencil and a piece of paper, just note that down. We were expecting a 40-day cycle peak to occur on the 12th of March. That's what the zigzag tool was telling us to expect. And if we display the CML composite model line, you can see that shows us a little more detail. We were expecting a first peak to form over here on the 14th of February, then another peak to form over here on the 25th of February. Is that the 25th of February, 26th of February, and then this peak over here on the 14th of March. Okay, so you can see in that composite model line these three peaks. Now the composite model line is not perfectly accurate in terms of the actual price level. It's important to say that the price level is interesting information, but it's the least reliable part of the information of the composite model line, the price level. Sometimes it turns out to be remarkably accurate, but what's more important about the composite model line is what it tells us about the structure of the market in terms of how the market is expected to move, when it is expected to form peaks, and when it is expected to form troughs. So we were expecting 3 peaks over there. Okay, 14th of February, 26th of February, and 14th of March, according to the composite model line. So let's take a look at an updated analysis, and let's take a look at what actually happened. So I simply saved this analysis with a new name, and I updated the data, and here it is. So first of all, in terms of the bigger picture, you can see that this 20-week cycle trough has been confirmed as having occurred in early February. There's that 20-week cycle trough, which was a nest of lows in our February webinar. But here it's been confirmed as a 20-week cycle trough as having formed. Let's take a look at how the market actually played out in terms of our expectation and what actually ended up happening. As I mentioned, there were 3 peaks found in the composite model line in February. The first was the 14th of February, was it? I think it's the 14th of February. So here is the 14th of February. Let me just put a little circle there. There's the 14th of February. That was our peak in the composite model line. The next one was the 26th of February. That's the 26th of February. So again, we can put a little circle there. That's the time that peak was expected. And finally, the 14th of March in the composite model line. There's the 14th of March over there. And the zigzag tool gave us a projected peak for the 40-day cycle of the 12th of March, you might remember. Okay. So using those tools to help us to understand the implications of the analysis, we were expecting peaks to form in the market where I've drawn these circles. I don't need to draw any more diagrams for you, I don't think. You can see how remarkably accurate that turned out to be. The market did indeed, let me wipe those out, the market did indeed form 3 peaks, 1, 2, 3, and that third peak has already been confirmed as the peak of the 40-day cycle, which is what we were expecting. We were expecting it on the 12th of March, back on the 12th of February, so looking ahead a month, we were saying we're expecting a 40-day cycle to peak to form on the 12th of March. As it happened, it formed on the 13th of March. Okay, and then of course price moved down. Let's take the comparison just a little further and speak about what's happening now, and then we will focus on what's happening now and speak about what's expected to happen next. So let's turn off this zigzag. Now, back in February, as you can see, the cycles here at the foot of the chart are getting really very messy. These are all nests of lows, but they're all getting a little bit messy. And the reason why they're messy is because we don't have enough sort of information yet to clarify the picture. So a picture, when you're looking ahead, always gets vaguer and vaguer the further you go into the future. But the composite model line was telling us to expect a trough over here, which is basically over the weekend that has just passed, and then a little bit of a move up. And that move up was into this 80-day cycle peak. And the sort of center of that peak in terms of the CML is the beginning of next week, so in 1 week's time. So we're expecting an 80-day cycle peak. We were expecting an 80-day cycle peak on about the 17th of April. We were expecting that back in February. Let me just point out an interesting thing here, and that is this 80-day circle back in February was on the 6th of April. So you can see that that 80-day cycle peak was inclined to be expected slightly early. If I connect all the circles, you can see it's sort of leaning over to the left, which means that chances are it was going to happen slightly early. So let's move to our current day. Let's bring things up to date, and let's start speaking about what we're expecting now. So I pointed out that back in February we were expecting a trough, a low point round about the weekend that has just passed, which is over here, and then we were expecting a move up until about the 17th of April for this 80-day cycle peak. So you can see that as time has passed, our analysis has been updated, it has been refined, but the basic structure of the market and what we're still expecting to happen in the market is unchanged, really. So let's start speaking about what we're expecting now. Let's first of all speak about this 80-day cycle peak, because we've been speaking about that. So first of all, here's the nest of lows for this 80-day cycle peak. It's a little bit staggered, as you can see. We've got a very nice sort of arrangement from the 40-day, 20-day, 10-day, 5-day over here, still expected early next week. But this 80-day cycle circle has been displaced off to the left. So why does that happen? It happens because the nest of highs and lows are constructed on the basis of the recent wavelength of each one of these cycles. And if a particular cycle gets displaced off to the left, then it means that there's probably been a shift, a change in the wavelength of cycles, and you can see exactly what that shift is here as a matter of interest. The shorter cycles from 40 days and shorter have grown longer. Can you see that? Because they have been displaced to the right. So recently they've grown a little bit longer. All right. The 80-day and the 20-week cycle, which are perfectly lined up over there, are still perfectly lined up, and they are showing a shorter wavelength. So what that means is that recently the shorter wavelengths from 40 days and shorter have been exhibiting shorter wavelengths, okay? Whereas the longer cycles are still referring obviously further back into the past because they are longer cycles, and so back in the past those cycles were beating with a shorter wavelength. Of course, we don't expect one cycle to get shorter and the other cycle to stay the same. We expect the entire nominal model, our full list of cycles, which is a dynamic breathing model, we expect it all to expand and contract, kind of like a living entity, in order to keep the harmonic ratios of all these cycles intact. So if the shorter cycles have been getting longer, then there is the probability that gradually all of the cycles in terms of their peaks are growing longer, and we might expect the longer cycles also to start expanding. But let's take a look at this 80-day circle. These circles are amazingly powerful. When I first started working with Hurst cycles, I used to mark on my charts, which I was doing manually in those days. I used to really mark these circles so that I wouldn't miss them. So I'm very used to looking at these circles and paying close attention to them, even when they are displaced. So this 80-day cycle circle has been displaced from its nest of highs. Okay, but nevertheless, it is an important thing to pay attention to it. Where is that circle? That circle, you can see, was actually pretty much over Friday. Okay, well, somewhere between Thursday and Friday. And what happened in the market? Well, we did get a little bit of a peak forming there in the market. So that's the first observation that I would like to make. We have an 80-day cycle circle. We have a little bit of a peak. So far it's only a one-day peak. It's not a big peak by any means, and there was a bit of a move down on Friday, of course, but it wasn't anything exceptional. We've had bigger move downs recently, but nevertheless there was a bit of a move down. Is it possible that that is the 80-day cycle peak? Yes, it is possible, and we need to bear that in mind. So let's take a look at some of our tools for working out what we're expecting to happen next according to this analysis. Well, here's our composite model line. And our composite model line is telling us that price is currently bouncing out of a 40-day cycle trough. And we must come back and speak about that 40-day cycle trough in a moment. It's bouncing out of that 40-day cycle trough up to this place here. Now, what is that place? That place is, very simply, the 80-day cycle peak. So price has been moving up to the 80-day cycle peak. But as I've just pointed out, it is possible. It's only a possibility, not really a probability yet, but it's possible that that 80-day cycle peak has already formed. So the message that the CML is giving us is that price is moving up from the 40-day cycle trough up to an 80-day cycle peak. But we must bear in mind that it is just possible that that 80-day cycle peak has occurred early because of this early circle over here. So we must bear that in mind, and we must act accordingly. You know, I'm not piling on long positions at the moment just to achieve this 80-day cycle peak, because there's the possibility that it might have formed. Let's come back and speak about this 40-day cycle trough, and let's turn off that composite model line just for a moment and speak about this 40-day cycle trough which has formed over here in the markets. And let me just do some measuring here. So our 20-week cycle trough formed in all likelihood on the 6th of February, I think. And so this analysis has the 40-day cycle trough positioned over here at 45 days. Now that's really long for a 40-day cycle. The average length of a 40-day cycle is expected to be 34 days. So 45 is really long. It's kind of, 30% long, but it's not impossible. There's another trough that formed, of course, last week on Monday, which was at 55 days. That's 21 days long. Well, 55 days really is a bit too long for a 40-day cycle, which is why Sentient Trader has positioned the 40-day cycle over here. So there are various possibilities in terms of this 40-day cycle. One possibility is that Sentient Trader is wrong, and that 40-day cycle trough shouldn't be positioned there at all, and that perhaps this should actually be the 40-day cycle, which means that then we should get a really strong move up into this 80-day cycle peak. Okay, we didn't have a very strong move. We had a 3-day move followed by quite a big correction, which obliterated at least 2 days worth of the upwards move. So that doesn't look very likely to me. And as I've mentioned, 55 days is really a bit long for a 40-day cycle. So the other possibility, of course, is that Sentient Trader is right, and that this is a 40-day cycle trough. Okay, but price only bounced out of that 40-day cycle trough for really 1 day. Then it came down again, then it sort of fiddled around, then it dropped lower, and then it went up again. What does that mean? Does that mean that, Hurst cycles is nonsense and there was no 40-day cycle? No, in my opinion, it doesn't mean that. In my opinion, what it means is that there's a lot of bearish pressure. And so if the 40-day cycle trough did form in the 3rd week of March, which I think is really very probable, then the bounce out of that 40-day cycle trough has so far been a miserable affair, as you can see. And when bounces out of troughs are a miserable affair, it usually means that there's quite a lot of bearish pressure pushing downwards. Okay, are we expecting bearish pressure? Well, yes. I don't know if you've noticed this really big stack of triangles over here. We are expecting bearish pressure because, in my opinion, at any rate, a very important peak, I almost said trough, very important peak occurred at the end of January, and all of these cycles, and there are a lot of them there, all of these cycles are in that case pushing downwards. So there is a lot of bearish pressure on this market. So is it a big surprise that we didn't get a big move out of the 40-day cycle trough. No, it's not a big surprise at all. So I think that's a very reasonable position for the 40-day cycle. Another reason why I think it's a very reasonable position for that 40-day cycle is because the market's described an absolutely perfect M shape in the formation of that 40-day cycle. Isn't that a beautiful M shape? I'm sure you know about my theory that cycles form M shapes in financial markets, and there is a very beautiful, it's a textbook example of an M shape. And let me just zoom right in on it. No, that's actually a little too much zoom because we can't really see it properly. Let's just stick with it as it is, and I can show you some of the other details about this M shape. One of the things that's quite interesting about this M shape that formed is that we have the initial move up, and then we have a bit of a correction, which is called the mid-channel pause. And then it comes up to the first peak. Then we come down to the trough of the intermediate cycle, which is the 20-day cycle. Then we get a move up to the second peak, which is almost equal. It's a slightly higher peak. Then it comes down again, and we get a little bit of a mid-channel pause, and only a very little bit of a mid-channel pause on the way down then into this 40-day cycle trough. So those things combine to increase my confidence in the placement of that 40-day cycle trough. Now, so I'm feeling fairly good about this analysis. What are we looking at now? Well, as I mentioned, we're looking at price coming up into the 80-day cycle peak, which is really expected sort of pretty much next week. That's the sort of center of that nest of highs. But it is possible, particularly because of this circle, it's possible that that peak has occurred. So we need to be on our toes and standing by just in case that peak has occurred. What's going to happen after that? Well, what's going to happen after that is price is going to come down into this 80-day cycle trough, which, as you can see, is expected in early May, basically. And we have another interesting formation, something that we spoke about in our previous webinar a few times. There were a few examples of it, which is this floating circle of the 40-week cycle trough, which is right above this nest of lows. I hope you can see that. Perhaps I've sort of drawn over it too much. Here's this 40-day cycle trough circle floating over the nest of lows for the 80-day cycle. Okay, I mentioned it several times in our previous webinar. It's something that you will sometimes see. What does it mean? It means that recently the 20-week cycle, this dark green cycle over here, hasn't been very reliably positioned in the phasing. When our cycles are correctly phased, we should get these perfect stacks of nests of lows. And you can see we've got pretty good stacks of nests of lows, and we've got pretty good stacks of nests of highs up to the 40-day cycle level, and the trough analysis up to the 80-day cycle level. But that 40-week cycle is just sort of floating there. And you would expect the 20-week cycle circle to also be here to create a full nest of lows. But it isn't, it's over to the right. And that's because of the positioning of this 20-week cycle, which, as we discussed in February, is a moot point. It's something that we could debate. Is that the 20-week cycle, or is it maybe only the 40-day cycle? Okay, so what do we do about this nest of lows in May? Do we disregard it? Do we say, oh, there isn't a 20-week cycle circle there, so I'm going to ignore it? Not at all. We pay very close attention, and we are going to be watching for a trough to form in early May. It might be the 80-day cycle trough, or it might be the 40-week cycle trough that is forming, in which case our position of that 20-week cycle trough is incorrect. So what is my confidence in this analysis? My level of confidence in this analysis in terms of the troughs doesn't go up to the 20-week cycle. I'm not very confident about that position of the 20-week cycle, but I'm confident about all the cycles up to that. In other words, up to 80 days. And that's good enough for me to be making trading decisions on the basis of this analysis. It might not be for you, depending on your time frame. So let's throw up that CML again and just take a look at what the CML tells us to expect. The CML is telling us to expect price should come up to the 80-day cycle peak, which you can see because of the center of gravity calculation is expected towards the end of this week. But it's just possible, dare I repeat that yet again, just possible that it has formed already. The next sort of big move that we're expecting is this downwards move, bringing price down into a trough, which is going to be a trough of either 80-week magnitude or even 40-week magnitude in early May. Now, what about that 20-week cycle? What if that 20-week cycle didn't form there? Well, I'm still keeping an eye on the other analysis. As I've mentioned so many times, I think it's really important to keep an eye on different analysis possibilities. So here is the other analysis, which has the pinned 20-week cycle trough back at the end of December. And you can see that the trough that formed in February was indeed confirmed as the 40-day cycle trough. And that trough was the 20-day cycle trough. And the trough that we're expecting to form now is this nest of lows, the 80-day cycle trough. So this is still a possible and valid analysis. In my opinion, this is still the slightly less likely analysis, because I think it's more likely that the 20-week cycle formed a trough in February, but it's a very valid analysis, and we have much neater nests of lows. Can you see that over there? Okay, so here we have a nest of lows leaning over to the left for the 80-day cycle. So according to this analysis, the 80-day cycle trough is really expected kind of now. That 80-day cycle trough could have formed there, but as I've already mentioned, the bounce out of that trough is really very miserable. And we would have expected a little bit more of a bounce for an 80-day cycle trough despite the bearish pressure. And according to this analysis, of course, price is then expected to come up to the 80-day cycle. It's not drawing, there we go, 80-day cycle peak over there. And we have exactly the same analysis up in the peak, so there's no big mystery. We've got the same circle of the 80-day cycle over there, so it's possible that that has already occurred, in which case, of course, the next move will be the move down into the 40-week cycle trough. And according to this analysis, that 40-week cycle trough is expected any time from the first week of May up until about the end of May over there. Okay, so that's what this analysis is showing us. Let's put up the composite model line for this analysis. So here we can see the composite model line here is giving us a bit of a sort of a wobble. We're still expecting a move up into the 80-day cycle peak, but don't hold your breath. Price has already sort of done that move effectively. So yes, we're still expecting the move into the 80-day cycle peak. Once that 80-day cycle peak occurs, we're expecting a move down, as shown by the descending composite model line, into the 40-week cycle trough, which is over here. After that, of course, after that trough forms, we're expecting the market to move up again. Okay, because markets will keep bouncing up and dropping down and so forth. Let's just zoom this out to the kind of zoom scale that we had. Here we can see the composite model line giving us a sort of a further outlook. You can see we're expecting the move up to the 80-day cycle peak. Then we're expecting the move down, which is really the focus of today's webinar, because that's the next move that we're expecting. We're expecting the 40-day cycle trough to form. Then we're going to get a bit of a recovery up to this 20-week cycle peak, which could be in June sometime, perhaps about the middle of June, and then we're expecting another downwards move, and so it will continue. And let's go back to our 20-week cycle trough having occurred in February, which, as I've mentioned, is, in my opinion, a slightly more likely analysis. And so here we have the next move that we're expecting, which is the move down into the 80-day cycle trough. Then we'll get a little bit more of a bounce, and then the market sort of subsides gradually downwards into a trough towards the end of July. I must remind you that looking further and further into the future using the composite model line, things get vaguer and vaguer, the further you go into the future. So I'm not focusing too much on this sort of move down just yet. I'm definitely focusing on this move. Oops, I've drawn all right over it. I'm definitely focusing on this move over here. And, once we get that move and we see the bounce out of this trough, then we can say with more confidence whether that is an 80-day cycle trough, whether it's a 40-week cycle trough, or whether the 40-week cycle trough still lies ahead, and so forth. Obviously, we update our analysis every step of the way. So that's what I'm expecting in terms of the analysis at the moment. I hope that you can see how the markets have been really following the Hurst cycles patterns that we've been expecting. The cycles have been beating regularly, and it's been a really good time to be trading markets on the basis of Hurst cycles because things have been fairly clear. I would like to now just spend the last sort of 10-15 minutes of today's webinar speaking again about a concept that I've introduced in previous webinars, but it's a very useful tool. It's a tool that I actually use in all of my long-term investments. It's a concept I've introduced before, and I'm not going to spend ages explaining it, but the concept is something that I call relative value investing, or RVI. And relative value investing works on the principle that when you are investing in something or in various things, what you want to do is you want to benefit from the increase of value, the relative increase of value between those different things. At its most simple level, relative value investing requires that you choose three things. So the three things I'm going to be speaking about today are cash, the US dollar, okay, the stock market represented by the SP 500, okay, so that's cash, stock market, and the third thing is gold. We spoke about gold in our previous webinar. So the concept of relative value investing is not a groundbreaking concept because it's what we're all doing actually, but it's just an acknowledgement of that and a way that you can use Hurst cycles to benefit from acknowledging it. The idea is that instead of keeping your money in a bank, which is your cash, of course, and then deciding to buy the S&P 500 and then selling it, and then buying it and then selling it, or buying gold and then selling it, what you instead do is you shift your assets from cash to stock market to gold, and you shift your assets from one to the other in order to benefit from the relative change in value over time between those different instruments. So of course what you're doing, if all you do is ever buy stock market shares and then sell them, what you're doing of course is that you are exchanging along this relative value line between cash and the stock market. Okay, so you buy the stock market and then you expect to get an increase in value of the stock market, and then you sell the stock market and you expect to benefit from an increase in value in your cash or a drop in value of the stock market. But using the relative value investing concept, you would shift your assets between all three of these. And as I mentioned, 3 is the absolute basic minimum. You can get a lot more complicated about this, but we're going to keep it simple today. So instead of simply selling the stock market and converting it back to cash, you would instead transfer your assets from the stock market into gold. Okay, you can't do that directly at the moment, although there are some interesting new trading platforms that are beginning to allow you to work in this way. But what you would do is, of course, sell your shares in the stock market and buy gold at the same time, effectively converting your assets from stock market to gold. And of course, at times you can sell your gold and convert it into cash. So the concept is that you shift your assets between these three things, you never have all your assets in one thing. You would have a percentage of it in gold, perhaps a percentage of it in the S&P 500, and a percentage in cash. And at various times, you'll have different percentages in the different instruments. So that's the concept behind relative value investing. The reason why I'm bringing it up today is because one of the side effects, if you like, of using this investment approach is that I don't just analyze the S&P 500 in terms of the numbers we're seeing here on the right-hand side of the chart, which is the index level, which is simply a number, of course. It's not a number of dollars, but effectively it's represented by dollars, because you can buy the index by paying a certain number of dollars, $12.50 usually, depending what kind of contract you're buying. So you can buy the S&P 500 with dollars by referring to this number. So this price scale is, effectively US dollars. Okay, it can be converted into US dollars. So this chart that we're looking at, and I'll clear all of these marks, this chart that we're looking at represents the value of the S&P 500 valued in US dollars. But I'm not only interested in the S&P 500 valued in US dollars, I'm also interested in the S&P 500 valued in gold. And as a matter of interest, I'm interested in it valued in oil and silver and all kinds of other things. But today I thought it would be interesting to take a look at the S&P 500 valued in terms of gold. So here is a chart of the S&P 500 valued in terms of gold. And on the right hand side here is our price scale, of course, and as opposed to that being US dollars, that is an amount, and I'm going to try and write amount, which is probably a bad idea, amount of gold. I could say ounces of gold, but I won't, because it isn't actually ounces of gold. But effectively, the price scale tells us how much gold we need to buy the S&P 500 index. Okay, so that's what this chart is. I hope that makes sense to you. So this analysis shows us effectively the relative value between the S&P 500 and gold. So I'd like to explain a few things about this, because I think it provides us with some interesting insight. So let me just rescale these charts a little. There we go. Okay, first thing is that the S&P 500 relative to the US dollar started increasing in value, bouncing out of an 18-month cycle trough in the third week of August of last year. If we now switch back to our S&P 500 valued in terms of gold, you will see that the 18-month cycle trough, as opposed to happening in the third week of August, which is over here, actually the S&P 500 started increasing in value relative to gold in the first week of September. You see that? Okay, that's our 18-month cycle trough. Gold then went up, and it described a very nice little zigzag, and it formed a peak in early December of last year. Now, let me just sort of draw a nice little circle around that. There's an 18-month cycle peak in the value of the S&P 500 relative to gold in December of last year. So then, of course, the S&P 500 dropped relative to gold, came down to a trough here at the end of the year, and it came up again and formed another peak. Now, if you're familiar with classical technical analysis, which I hope you are, you'll probably recognize, what is effectively a double top. It's not a perfect double top, but it's very close to being perfect. So we had a double top that formed. Of course, this top that formed over here is the peak that we are now very familiar with on the 26th of January Is that right? 26th of January that peak formed. In fact, this peak in relative to gold formed a few days later. It was the 29th of January, I think. But it's the same peak that we're looking at. So there are a few interesting observations to make by taking a look at the value of the S&P 500 relative to gold. The first thing is that in November of last year, I was talking about an imminent peak forming in the S&P 500. Now, one of the things that influenced or motivated that was the fact that we were also expecting the S&P 500 to form a peak relative to gold. When that peak did form and it started moving down, fairly strongly, that gave a Hurst Cycles analyst, or myself in this particular example, increased confidence in the fact that indeed stock markets were forming the peak. Okay, but that peak was hardly visible when it was valued relative to the dollar. Okay, so in terms of a relative value investing concept, in December we were expecting a peak in the S&P 500. So we definitely transferred some of our assets from the S&P 500 to gold in December, okay, because the S&P 500 formed that peak. But it hadn't formed that peak yet in December. It hardly moved down at all. Obviously we require a little bit of a move down before we're going to start transferring assets. And so therefore, some of our assets would have remained in the S&P 500 to benefit from the relative value change between the S&P 500 and the US dollar. However, at the same time, it was not experiencing the same value change relative to gold. When the second peak in gold approached in January, and we were really reaching a very overdue peak relative to the United States dollar, the probability of the peak forming in both gold and the dollar increased tremendously. So I hope that looking at the S&P 500 value relative to gold has been an interesting thing for you. I'll point out another few interesting sort of side effects of doing this. One of them is that this whole period from August until January was a really difficult time to analyze when you were looking at the S&P 500. Because, as I've mentioned in previous webinars, identifying these troughs, these low points, was really very difficult because the market was moving up in an ever-accelerating upwards movement. So performing that analysis becomes really quite difficult. Where are those troughs? What's happening in the analysis? So the answer to help you to do that is to take a look at the instrument that you're analyzing relative to something else, because that really helps you to identify and position those troughs. You can see here during the same period of time, although we also had an upwards movement, you can see how much easier the identification of those troughs was, because we had strong, really clear and obvious troughs. So this particular analysis of the S&P 500 relative to gold is in many ways much easier, or has been much easier over the recent time period. It isn't always easier, but over the recent time period it's proved easier than simply analyzing the S&P 500 relative to the United States dollar. So I hope that you find that interesting. As a matter of interest, let's just see what the composite model line is telling us to expect in terms of the S&P 500 value relative to gold. Okay, in our previous webinar, I discussed the fact that I'm expecting the price of gold to increase up until about sort of the middle of the year. And of course, we are generally expecting the price of the S&P 500 to decrease. So it's very interesting to observe this composite model line, which is showing us quite a lot of volatility, indicating that the magnitude of the shorter cycle, in this case the 20-week cycle, has recently increased. So we've got a big increase in magnitude of amplitude of the 20-week cycle recently. So we're looking at quite a lot of sort of fluctuations of the 20-week cycle, and we're looking for generally a little bit of an upward movement up to this 20-week peak, which should form here in about sometime in May, and then we're looking at quite a strong move down. So, the next big move in terms of the relationship between S&P 500 and gold is really this move down here. So what does that move down mean? This move down here, just to be clear, that move down means that during that period of time, going into it's basically sort of the month of June, or to the end of May into June, the S&P 500 is going to lose value relative to gold, or gold is going to increase in value relative to the S&P 500, or both. The important thing is that if you are making investments during that period of time, you would want your investment to be in gold as opposed to the S&P 500. How much of your investment would be in cash at that time would be a question that you would need to answer by taking a look at the chart of the S&P 500 relative to the United States dollar, of course, which is this chart that we've been looking at over here. So on that note, let's take a look and see if there are any questions that I can answer. The first question had to do with I think it was, which analysis was it? It was the S&P 500. It had to do with when circles, I'm paraphrasing it here, but it has to do with when circles are converted into diamonds. Okay, and so I think we were looking at a chart at the time that the question came up that was something about this scale here. And as I think it was Bull Trader pointed out, there was a low point in price here on the 2nd of April, and down here at the foot of the chart we have the expected 10-day cycle. There are the circles and whiskers. So why hasn't Sentient Trader converted those circles into diamonds? So it's a very interesting question, and it's a very important question actually, and it has to do with the way in which Sentient Trader performs an analysis. Not just the way in which Sentient Trader performs an analysis, but the way in which an experienced Hurst analyst learns to do this. What happens is that, of course, the circles at the foot of your chart are telling you when to expect a trough or a peak to occur. And it's the circles that are important. A lot of people, when they start working with Hurst cycles, fall in love with the concept of the diamonds, because diamonds, are very sort of confident boosting symbols, and they fall in love with the diamonds, and they keep wondering why the software isn't positioning diamonds there. The important thing is not the positioning of the diamond. The important thing is the expectation that the circles give you in terms of what to expect. So Sentient Trader does not confirm a diamond until it has enough data to say with some degree of conviction that that was a trough of the cycle that was expected. So in this particular case, Sentient Trader is expecting a trough of 10-day magnitude round about here on the 2nd or 3rd of April, and there have only been 1, 2, 3, 4 days since that trough, and if price comes down very hard today, for instance, then it would be clear that that trough on the 2nd of April was not the trough of the 10-day cycle. It's almost as if though every cycle has a burden that it carries with it. In fact, when I was developing Sentient Trader, I did call it a burden. There's a cycle burden that is carried with every trough. And so before Sentient Trader will provide you with a confirmed diamond, it needs to make sure that it has enough evidence that that trough or peak has formed. I see Geo says the audio is fading in and out. I apologize if there are problems with the audio. As I've mentioned, I'm having some issues with internet connectivity. And Bull Trader suggests I pay the Italian mafia. In fact, I pay for the best internet available in this area. Unfortunately, I am a bit in the countryside, so I do apologize if the audio is not good. So I hope that answers the first question about when circles become diamonds. Sentient Trader needs enough evidence that a trough has formed before it will actually put a diamond there and confirm that diamond in that position. Our second question had to do with when the volatility increases. I see a message from another Geo. Thanks for the interesting visit. I used book number 1. Okay, good. Presumably Hurst Cycles book. That's fantastic. The second question had to do with when the volatility increases, do the wavelengths of cycles change? And the answer to that is no. If all you have is an increase in volatility, then you don't expect the wavelengths of cycles to change very much. There is a relationship between the amplitude of a cycle, which is of course what gives us the volatility, and the wavelength of the cycle. And so when you get increased volatility, generally you might expect the wavelength to increase as well. But in fact, I found that to be a very unreliable relationship. And so it's very hard to draw absolute guidelines about an increase in volatility leading to a change in wavelength. I found that to be very unreliable in my experience. Of course, when you have increased volatility, it means the shorter cycles are exhibiting greater amplitude. They are moving with more strength. But just because they are currently moving with more strength does not necessarily mean that their wavelength is also expanding. Okay, that was question number 2. Question number 3 had to do with zigzags and how the zigzags calculate price levels. So let's just display some zigzags here. And let me just display the 40-day zigzag, and I can explain how the zigzags do actually generate price levels. And the way in which that happens is that a zigzag consists of 3 moves. Okay, so if we look back in the past a little bit, then you can see here we have move number 1. That's move 1. Here we have move number 2, and here we have move number 3. Okay, and there is what I used to call the cycle line that extends through there. The way in which zigzags do generate price targets is that they calculate the point at which this central leg number 2, crosses down below the cycle line that is moving from the trough to the peak, or from the peak to the trough. And its initial price target is generated on the basis that that crossing point is expected to be at the 50% level. So that's how zigzags calculate price targets. It's not a very accurate way of projecting a price target, but it gives you an initial starting point, if you like. The other way in which zigzags do calculate price targets is that they measure what I call the bounce and the plunge out of previous cycles of that same magnitude. So when this 20-week cycle trough formed in the market over here, there was a 40-day zigzag that we were looking at. So Sentient Trader goes back and it looks at all the previous 20-week cycle troughs, and it measures the strength of the bounce out of that 20-week cycle trough. It averages that, and it uses that information to help it to generate a price target for the zigzag coming out of that cycle trough or dropping out of that cycle peak. So I hope that answers that question. The zigzags do calculate price targets. Sometimes they're amazingly accurate, sometimes they're not very accurate. It's just the nature of the game. But they do calculate price targets, and so they give you useful additional information. The fourth question that we had was about the tweets that we put out on Sentient Trader about whenever price touches an FLD that we think is interesting, we will generally put out a tweet about it. And so the question was, what does it mean when it says price has touched an FLD from above? So let's just look at a few FLDs. And, what does it mean when price touches an FLD from below, and so forth? The interaction between price and the FLD is a wonderful thing. Many of you will know that I have for many years worked with a trading methodology that is based entirely upon the interaction between price and the FLD. It's a very powerful tool, but the interactions between price and the FLD follow a fairly reliable sequence, but that sequence can be a little bit complicated depending on the conditions in the market. So here you can see a time where price came down to the FLD and found support. Here price again came down to the FLD and found support. Here price came down to the FLD and just sliced straight through it. So that is an example of why the interaction between price and the FLD is fairly complicated, and that's why our tweets mention the fact that price has interacted with an FLD, but it doesn't say what is expected. You need to apply your reasoning and your understanding of how price interacts with the FLD to the situation, because each situation has its own unique characteristics. Okay. We had a final question just before the end of the recorded content, which had to do with the relative value investment approach. Okay, so this is the S&P 500 valued in US dollars. So just a quick overview of that again. The idea is that you work with a minimum of three things: US dollars, S&P 500, and gold. When the S&P 500 is increasing relative to the US dollar, then of course you want to be invested in the S&P 500. When gold is increasing relative to the S&P 500, then of course you want to be invested in gold. And when gold is increasing relative to the US dollar, you want to be invested in gold. So the concept is that you take all of your assets and you split them up. You give a certain percentage to each of these, depending on how these different instruments are moving. So if the S&P 500 is climbing, then you might add 30% to the S&P 500. If gold is climbing relative to the US dollar, then perhaps you put 30% in there. And if gold is climbing relative to the S&P, then you would put another 30% in there, and perhaps you just leave 10% in cash, because cash is not performing well at the moment. So I hope that answers that question. Okay, so on that note, thank you very much for joining me. I do hope that you found the webinar interesting. Thank you for your interest in Hurst cycles. I wish you profitable trading, of course, and look forward to seeing you at our next webinar next month.